All right, so let's look at this. So why were we having the understand the context of, in case some of you are feeling lost, why, well, the context of the entire long discussion on TAM versus AM. Maybe we can just put some colors here for the parts, because we're not highlighting every aspect of, oh, forget about it, let's just leave it there. We can make it, we can put it in italics. So we had a long discussion on TAM versus AM asset management, okay? Why is that? It's happening in the larger context of our survey of the financial services sector and the different types of firms that exist, okay, within that. So having completed the TAM versus AM discussion, we are going back to this, and I'm just pointing out one little aspect of this discussion on depository financial intermediaries and financial disintermediation. So I'm just adding a little bit to your notes here. So the classical form of financial intermediation is provided by what type of institution? Depository financial intermediaries, okay, banks, okay, and this, I'm just adding to the idea of financial disintermediation here, okay. What I'm trying to say is that, okay, please, in real life, please don't write disintermediation like this. I'm writing it like this only to sort of make it very clear that I'm talking about disintermediation, not intermediation. So don't write it like that in real life, okay. Okay, the classical form of financial, everybody understands now what is financial intermediation. The classical form of intermediary, the financial intermediary, is the depository financial intermediary, right? And who are they? Banks, okay? So commercial banks, credit unions, and all commercial cooperative banks or whoever, okay? Everybody doing this depository financial intermediation business, okay? So when we talk about financial disintermediation, okay, the classical form of financial disintermediation therefore would be, because the classical form of intermediation is the one done by the depository financial intermediaries, right? So when you're talking about the classical form of disintermediation, okay, the pure form of financial disintermediation, it also has to be that type of disintermediation which knocks out the depository financial intermediary, all right? So it knocks out the banks. Let's take a simple example and use the banks, okay? So therefore, when you're talking about the classical form of financial disintermediation, because I've given you a broader definition, where whenever banks, whenever actually not borrowers, but they should be, because you're talking about the broader so it should be fundraisers or capital raisers or fund deficit and entities is a better way to refer to them. Did I use this term with you before? Funds deficit entities bypass banks and raise direct finance, because we are using the word stocks and bonds. So this is a loose way of using the word financial, the expression financial disintermediation. Okay, this is not strictly correct. The strictly correct classical form of financial disintermediation refers to the disintermediation of the, I'm going to write it in kind of, removing the banks as, so it's not very well written. I'll try to polish up the definition later, but you understand what it is. The classical form of financial disintermediation will refer to the process of knocking the banks out, okay? So when you're knocking the banks out, what is the bread and butter business? We have two bankers here who are joining wholesale divisions of banks, okay? Now, what is the classical, what kind of finance do banks typically provide? The bread and butter business of banks. Do they provide long-term finance or short-term finance? Both. Well, actually that's not correct. The bread and butter business, the classical form of finance provided by commercial banks is short term. It's typically working capital finance which should liquidate within 1 year. Typically they provide, that's the kind of bread and butter business of banks. So of course banks have, very large banks have now moved into long-term finance in the sense of syndicated loans, and they do longer term syndicated loans. But that's why you notice that the reason that banks, okay, the sort of, where is that? Yeah. You notice that here we have another category of financial institution here. NBFCs, microfinanciers, and what are TLIs? Term lending institutions, okay? So you have all these IFCI, IDBI, all these institutions which were set up earlier. Okay, these were actually meant to cater to the classical function of the commercial banks has always been to provide short-term finance, okay? And that's why we had all these other institutions like which were called the term lending institution. Term here is meant to be implicitly refers to long term. When we say term means actually what we are implying is long term. Okay, so that therefore to complement the bank function of providing short term finance, you also arrange for some term lending institutions to provide longer term finance. In the more developed countries, the longer term finance is just because the capital markets are more well developed. They are you raise long term funding through the capital markets by selling debt securities. Okay, so essentially by selling what we call bonds. Okay, bond markets. And also that what has happened is where for the very large banks, they have developed these syndicated loan teams where they arrange syndicated loans for slightly longer terms periods than 1 year. Okay, but the classical bread and butter function of the bank has always been working capital finance. That's why if you see Prachi and Solanki have been taken into working capital, right? Business banking, that's going to be working capital finance mainly. Mainly you're going to be dealing with working capital finance and all kinds of other non-financial facilities like letters of credit, okay, bank guarantees, all these other kinds of bank products. Okay, so now so therefore what we are coming back to is to have a more subtle and refined definition of understanding of financial disintermediation is removing the banks as middlemen. Okay, so now that you know that the classical function of the commercial bank has been to provide short-term finance. Okay, so if you're going to knock the middleman out, okay, knock the bank out, what you have to do is you have to find some other way of getting short-term finance, not long-term finance. Are you following what I'm saying?
Yes, sir.
If the classical function of the bank, the bread and butter business of the bank is to provide short-term finance, working capital finance, okay, against inventories, receivables, etc. Okay, so therefore, when you're talking about a classical form of financial disintermediation, it has to be some kind of activity that deprives the bank middleman of his bread and butter business. Are you following what I'm saying?
Yes.
Okay, so what kind of instrument, can you tell me? I mean, we've already discussed this instrument. Therefore, when we are talking about disintermediation, okay, we're talking about disintermediation, which means we are going to knock out the bank, we are going to knock out the middleman, and the fund deficit entity is going to go directly to the fund surplus entity through the capital markets. Okay, but if you are going to knock out the bank, what kind of instrument should you be selling? Debt. Yes, debt is not incorrect. It's no, what I'm trying to emphasize is here short-term finance. So what kind of, can a corporation sell treasury bills? Commercial paper is the answer I was looking for. Okay, so that's the answer. So treasury bills can only be sold by the government treasury. Okay, so the answer I was looking for is commercial paper. Okay,
I already told before.
you said short-term finance.
I also said commercial paper.
Okay, I didn't hear you. Maybe he drowned you. He drowned you out. Okay, but that's good. So commercial paper is the answer I was looking for. So therefore, what I'm trying to emphasize here is that while people loosely refer to any kind of capital market issuance as financial disintermediation because you're raising money directly from investors in the capital market and you're cutting out the middleman, okay, but the pure and the classical form of financial disintermediation is through the issuance of instruments like commercial paper, okay, because it has to be something through which you're raising short-term finance through the capital markets. Okay, are you following? But you're not convinced. You understand why we are saying that? Because intermediation, the classical form of financial intermediation is that provided by the depository financial intermediaries such as commercial banks. Okay, and the bread and butter business of the commercial bank is to provide working capital finance, okay, which is short term in nature, okay, typically liquidating within a year. So therefore, to disintermediate the commercial banks whose bread and butter business is the provision of short term finance, you have to find some way of raising short-term finance through the capital markets. Are you following the logic now? Okay, and the way you do that, the most common instrument for doing that is commercial paper. Okay, so you'll find, as I mentioned to you, that the more developed markets, the more developed economies have very well developed capital markets. So in the US markets, you'll notice that most of the companies, even those which have a half decent name, they would be raising a huge amount of money through commercial paper. So the US CP market is a massive market. Okay, so which is why one of the reasons why one of the effects of the Lehman bankruptcy was to freeze up the US CP market. That's one of the reasons why. And so US corporations, even blue chip names like General Electric, had trouble raising money through the CP market, because the Lehman bankruptcy caused also so much disruption that the corporate CP market was also freezing up. And that's one of the reasons why the Federal Reserve jumped in with such, a sense of alarm and took such radical steps. So this is essentially, so what you have to understand is that if I ask you what is a classical form of financial disintermediation, okay, the correct answer would be the selling of commercial paper by, any kind of corporation, typically non-financial corporation, selling of commercial paper through the capital markets. Okay, and which segment of the capital markets would you be selling commercial paper in? Bond markets or money markets?
Money market.
Everyone is clear about that? Okay, because, and so therefore, what are the features? Give me two distinctive features of commercial paper?
Sir, maturity period and
Yeah, but what?
less than 1 year and there is multiple.
Yeah, so the two distinctive features of commercial paper will be that the initial maturity will be less than 1 year, and the coupon, there will be no coupon. It will be sold at a discount of face value. Okay, and what is the logic by which you work this? As I told you, your mental strategy. When you hear the word commercial paper, you will see that commercial paper. You will remember that commercial paper is a money market instrument. Then you'll go back to your definition of money markets and bond markets, and you'll remember that money market instruments have less than 1 year initial maturity, and then they have no coupon. They're sold at a discount of face value. So then you will apply the general attributes of that category of instrument from money market instruments back to commercial paper, and then you will say that commercial paper has initial maturity less than 1 year and is sold at a discount of face value, has no coupon. Are you following? This is how you should structure knowledge in your head. Okay, you'll have a general category, and then you have individual members of that category. So whenever you hear the name of an individual member, you will apply the general features of that category. Okay.
Then the definition is not correct.
Which one?
The banks and raise direct finance by selling stocks.
Yeah, this is a loose definition. That's why I wanted to amend this definition. Okay, I was just checking the notes. This is actually a loose definition. Some people refer to it this way, but you need to be aware that because the classical, that's why I'm using the word classical as well, because the classical form of financial intermediation, remember, which type of finance emerges earlier in an economy? Direct or indirect? Indirect. Okay, so the banking function is pretty old, and so this typically, so the classical form of financial intermediation is the bank finance function. And therefore, when the classical form of financial disintermediation will happen when you are selling things like commercial paper, basically shutting the banks out from their bread and butter business of short-term finance. Okay, this is a, let's call it a loose definition. We can just write it off. I'm not going to write perfect English here. Bread, butter business. Okay, deprivation of short-term finance, sell commercial paper directly in capital markets. Okay, so we can use this discussion of theoretical categories to once again recap why you will find this error in many books on finance. Okay, and these are often provided as textbooks in many other institutes. Okay, you will find that remember I told you a couple of sessions ago that this classification of debt markets into money markets and some of the books you'll notice they'll say that debt markets are divided into money markets and capital markets. Okay, why is that wrong? Remember, I think I told you this before. Do you remember? Let me just go back to, if I have a calc file for you guys here. Do I have a calc file? Or otherwise I'll use the IFM calc file and change it later. No, there's no calc file here. So let me just use the IFM calc file. Okay, I'll just do it here, and I'll just later on I'll do it. Okay, let me just do it here. So in many books you'll find this. Where is the coloring function? Okay, never mind. Okay. All right. So if this is capital markets, many books will say that. Okay, so many books give you this kind of classification. This classification is not correct. Okay, why is it not correct? Okay, so they will define, bond markets this way. Okay, or debt markets like this. They will define debt markets like this. If you put it this way and center it, and where is the merging button? All right, so they will define debt markets. They'll classify debt markets as money markets and capital markets. Why is it? You'll see this in many books. Okay, why is this wrong? I'm not sure if I mentioned this to you, but why is this wrong? Sorry? My question is, if you classify debt markets like this, money markets and capital markets, why is this wrong? A wrong classification? Why is this a problematic classification? Because, okay, let me just quickly do this, because anyway, this is just my view, but hopefully you'll see the logic in this. So if we classify all the students in the school into boys and girls, then is it safe to assume that the boys are not girls and the girls are not boys? That they're mutually exclusive? Remember, one of the rules of taxonomy is the categories should be mutually exclusive. Okay, what happened, Sushant? Why have you not come to the front bench? Why have you not come to the front bench? I'm going to deduct marks for you because this is not correct. When I'm then you should have told me that earlier. I'm not. No. I'm not interested. You don't have a choice as to where you're going to sit. You're going to sit where I'm asking you to sit.
I'm coming.
No, you can come now, but you haven't come before. So I mean, when I gave you the instructions. Where is he? Which group? No, this is what is meant by a group. When you go and work in, remember this, 1 minute. On the point, 1 minute. On the point that, so if you don't come now, I'll deduct another -2 at the end of the class. Okay. So 1 minute. The point raised by Kriti, please remember, okay, the point raised by Kriti, one of the things that people expect from MBAs, okay, remember when you're going in as an MBA, one of the things that people expect is that you have the ability to work in teams, okay, please remember that. Because when you're going in as an MBA, you're not a hardcore programmer or something like that. Remember, many organizations like Facebook now they don't care about MBAs. They care about what you can do. They will hold a coding contest, and they will hire even people from a class 12. They'll hire them directly, okay, because they don't care about whether you have a degree hanging around your neck. If you are a good coder, they'll hire you straight. But you're not, since you've chosen to do an MBA, you're not qualifying yourself as a technical person like an engineer or something like that, okay? So you have to remember that you better be good at what people expect from MBAs. One of the things they expect is good communication skills, okay? Good strategic ability, the ability to look at business problems from a holistic point of view, different functional areas, combining different functional areas. And the other thing that they will expect from MBAs is the ability to work in teams. And in this globalized world, it becomes more and more working in cross-cultural teams. Okay, so be aware of all these things, that if you're going to go into the world and market yourself as an MBA, okay, you better be aware of what people expect from MBAs, and you better be good at that. Okay, so you'll see there's an interesting case study on Zara. How Zara is well known for being able to push their products into the market with new designs very fast. Their turnaround times are very fast, and they have I was reading an interesting story on how they have all these different teams from all over the world working on the designs, okay, and how they get that together. So this is an aspect of cross-cultural, working in cross-cultural groups. You guys are doing courses on cross-cultural communication, okay? So please be aware, Kriti, okay? So that's what's meant by team, working in teams, okay?
-2.
No, he's come now, so he's okay. Okay, it was already -2. Okay, good, very good. All right, okay. Okay, now let me just quickly go into let me not waste too much time on this, because this is just my view. So obviously any taxonomy automatically implies that the taxa or the categories are mutually exclusive, okay? So therefore, what if you're saying money markets and capital markets, that means you're saying, one of the things you're saying is that money markets are not capital markets. Is that a fair assumption?
Yes.
Okay, now is it fair to say that any market where you can raise capital is a capital market?
Yes.
Sahil doesn't agree.
No, sir. Yes, I agree.
We agreed, remember at the very beginning, one of the ways you see that I'm giving you all the theoretical constructs is that we are using what is called the plain meaning rule of interpretation, in the sense that whatever, if it's a capital market, it should be if it's a sugar market, it's a market for buying and selling sugar. So therefore a capital market should be a market for buying and selling capital securities. Okay, that is, you issue capital and then you provide capital as the investor, and the capital raising entity will provide a capital security like equity or debt as a certificate that you've given me this money. Is that correct? So a capital market, is it fair to say, using the plain meaning rule of interpretation, okay, that a capital market should be a market where you can raise capital by selling capital securities? Okay, is this clear? Okay, so normally in the market and industry you can just use the term securities, because the classical meaning of securities refers to only equity and debt. Okay, so therefore I've made two steps. First, I've said that if you are classifying things into money markets and capital markets, then you're obviously saying that money markets are not capital markets. Okay, second step of the logic is any market where you can raise capital is a capital market. Okay, all right. Now, did we just discuss some type of instrument which is issued in the money market?
Commercial paper.
Commercial paper. So is it fair to say that commercial paper is a capital security?
No, it is a money market.
What are the two types of capital? Debt and equity. Okay, there's actually technically a third type also, hybrids, but we'll just say debt and equity. Okay, because some of the hybrid type of bonds will be sold in the DCM in the DCM component, and some will be sold by the ECM. Preference shares. Preference shares are technically a hybrid security. They are not really equity. Okay, so they are technically, but preference shares would be sold by the ECM team. Okay, there are certain types of bonds like contingent convertible bonds, etc., which are actually hybrid. They are not really debt securities, but they would also be sold by the DCM team. Okay, so let's keep the broad classification for now, debt and equity, to solve this particular thing. So is it fair to say that, so you know that commercial paper is a money market instrument? Okay, now is it fair to say that commercial paper is a capital security?
No.
No? Who is saying no? Gaba?
Or you said
No, you should feel free to say no. You don't have to agree with me. That is more important. That if you have any kind of doubt, you should immediately complain. Yes. So why are you saying? I'm saying that commercial paper is a capital security because it's a security issued to raise capital. Because here you have to agree that debt and equity are both forms of capital. If you think that only equity is capital, then of course your objection is correct. But is it more general? I mean, is it more generally accepted? Is it the more generally accepted view that both debt and equity are forms of capital?
yes.
Right? Okay, you agree with me so far? So if you accept that both debt and equity are forms of capital, then you will agree that commercial paper is what? Debt or equity? Debt. Okay, it's a debt instrument. Okay, so now do you agree? Don't agree because I'm like shouting at you.
I'm very clear from the logic.
Yeah. So if you agree that both debt and equity are forms of capital, then you'll agree that commercial paper is a capital security. Okay. So it is used to raise capital because it's used to raise debt capital. Okay. That will go into the debt side of the debt category in the balance sheet. Okay. So now, if I have used a money market instrument called commercial paper to raise capital, then does that not undermine this classification of money markets and capital markets? If I'm raising capital through the money markets, then, and if I say that capital, any market where you can raise capital is a capital market, then does it not undermine this classification?
Yes.
Okay, so that's what I wanted to show you. So this is just my view, but it rehashes your concepts of commercial paper, money markets, debt markets, all these things, right? Okay. So
if we don't say debt in capital as a capital, then we can classify this.
yeah, if you say debt is not a form of capital, then you can do that. Yeah. So his point is, this is also correct. That this is also good that you're also, while you're making a particular set of statements, you're also identifying the assumption, which if that assumption doesn't hold, then those statements will no longer be valid. So that's what he just pointed out, that if you say that debt is not a form of capital, then this will be a problem. Okay. So let me see, let me just once again I'll just put this into, I'll create a new sheet for you guys. Let me just quickly run through I don't think I've covered the concept of hybrid capital with you guys. Okay. So while we are on this topic, let's cover it quickly. Okay. So on the point of banks and capital raising. Sorry?
commercial paper can be for more than 1 year.
No, commercial paper is not typically not issued for more than 1 year. It is a money market instrument. It is typically issued at a discount, and it is for a less than, typically it is 6 months. I think if you check the US, if you go and do research on the US CP market, you'll find most of the CP is 3 months, 6 months, okay? Because it is rolling short-term finance, okay? It is a perfect substitute for bank finance, okay? Because it matches the operating cycle of most companies, okay, with this 3 month, 6 month, 9 month kind of cycle, because you're selling your products, your receivables are coming through into cash, then you can retire the CP, and then you have rolling CP. So most companies have, most large corporations will have rolling CP, they will have CP programs. Okay, so in the euro markets, we will not have time to study the euro markets. So in the euro markets, you'll find many companies having they're coming up with euro commercial paper programs. So the commercial paper issuance typically happens in large companies in the form through a program. That means you have an umbrella program. It's a euro commercial paper program, and under that program you are, because it's all short term, so you keep on rolling the CP outstandings. Sometimes it goes down, sometimes it goes up, but you'll have an overall program with a limit of maybe $100 billion or something like that, and then the issuance under that program will stay up. It has to stay below 100 billion, but it'll keep fluctuating depending on how you need financing and all that. That's how it typically works. Okay,
Sir, are commercial paper tradable?
commercial paper is tradable, not in India, because India is not very liquid, but commercial paper,
Security commercial papers are tradable, like in
yeah, it depends on how you have structured the agreement with the lender. Okay, it depends on how you structured, but you can have, actually you do have some amount of trading in CP. The banks will have CP trading desks. The bank money market, if you look at a big bank, if you look at a big money center bank, their money market desk, the money market desk will be trading, and they'll be trading, first of all, they'll be trading in what we call call money markets here. Okay, that is the reserve funds, the market for reserve funds, borrowing and lending between the banks. Okay, that's one big activity in money market, on the money market desk. Then they'll have all kinds of other deposit activity, okay, trading in deposits and forwards and swaps and stuff like that. And then one of the things they could also do is trade in CP, because that's a money market instrument. Okay, so that depends on the structure of the agreement with your the issuer of CP. Okay, so okay, you can see how long it's taking to load.
we are also trading in CP.
Yeah,
So now this thing
we are also trading in CP. Yes. Like Sushant just did a trade in CP. He saved 2 points by moving forward.
Nice.
Okay. Now, what was I going to do? Okay, so while discussing this point, let me just go back to the point that I discussed with these guys in your junior batch. That class was in November 18. Okay, let me just, so later on I'll paste the sheet into your calc file. I'll create a calc file for you guys. This is your junior batch lab, and then I will so what we are going to discuss now is just a little bit of a further expansion of the refinement of this idea that the two forms of capital are debt and equity. Okay, and as I explained to you, you still don't have within an investment bank primary capital markets operation. You are still not going to have a group which is going to deal with hybrid capital markets. Okay, it is still DCM and ECM. So preference shares, being a hybrid security, will still be sold by the ECM group. Okay, but we still should have some understanding, especially because I've given an example of a new type of debt security which has come up in the last 2-3 years, which is a contingent convertible bond. These are called COCO bonds. Okay, so contingent convertible bonds, you should be aware of this, that there is obviously preference shares. Preference shares is an example of what we call a hybrid security. It is not actually equity, and it is not debt. So it's kind of, that's why strictly speaking it's a hybrid security. So I'll just show you the structure of the balance sheet once again, and this was discussed in the Solomon case. You remember the Solomon case now? No, you forgot it. There was a company. Okay. Yeah, so okay, let's recap this. This is such an important case in company law, probably the most important case in company law, because your retention has been generally so poor. Let me test this. So what is the ratio of the Solomon case? You've forgotten what ratio decidendi is. One minute. We can't have so many answers. Give them the mic. Give the mic to Pallavi. Where's the mic? Move it fast. Give the mic. Get the mic relayed to her fast. Like a 4x100 relay team. Yeah. Mic. Use the mic. So my question is, what is the ratio of this? You've forgotten what ratio decidendi is. Yeah. What is it? Yes, Pallavi.
Uplifting of corporate views.
No uplifting.
Uplifting of corporate views.
So in the Solomon case, first of all, don't use the word uplifting. Either lifting or not lifting. Okay. So you said your view is that in the Solomon case, the corporate veil was lifted. Okay. Anybody else with a different view? Kriti, yes.
The company and the individual identity are the different. That like the Solomon and the Solomon and company are separate identities.
Okay. And so according to you on the question of the lifting of the corporate veil, do you agree with Pallavi or do you disagree? Was it lifted or was it not lifted? It was lifted. Okay. Anybody else want to comment? Sahil, you wanted to say something? Okay. Anybody else? We're not going to spend too much time. Okay. So Kriti is correct in what he said. Okay. And what she said on her own. That in what the Solomon case lays down, the ratio of the Solomon case is that the company by default the courts will honor the corporate veil, will not lift the corporate veil. That is, they will treat by default the company and the shareholders as separate legal entities. Okay, so the default action of the court is not to raise the corporate veil, not to lift the corporate veil. If you want the corporate veil to be lifted, you have to provide good reasons for doing it. Okay, good reasons as to why it should be done. Okay, so the ratio, your answer is not correct. The ratio in the Solomon case, the corporate veil was not lifted because they sought to make Solomon liable for the liabilities of the unsecured creditors. Okay, so therefore, the court refused to do that. Because the court said that the company was properly incorporated, there is no fraud involved. Okay, so remember that this is the default. Perspective of the court. Okay, so in cases like the Sahara case, why is Subrata Roy in jail? Technically, he shouldn't be in jail because that is whatever was done by Sahara, the company. Okay, it was not done by him as a shareholder. But because there is malfeasance, there is fraud. Okay, because the corporate entity was used to commit fraud and malfeasance, and he's actually technically in jail because he disobeyed the orders of the Supreme Court to pay money. Okay, he's in jail for contempt of court. But the point that the reason they went after him in the first place is that if you use the corporate veil to commit fraud or engage in malfeasance, then the veil will be lifted. Okay, so this is the point. Okay, so hierarchy of claims. You remember this term? Did we go through this term in Solomon? We went through this term. Okay, so hierarchy of claims just shows you who gets to eat first.
Yes.
The senior debt holders get to eat first.
Then preference shareholders.
Yeah. No, not preference shareholders after that. Then subordinate debt. Okay. So the point is basically hierarchy of claims. Remember this term. This is technical jargon from theoretical finance. You should remember this term. Hierarchy of claims on the revenues of the firm. As the firm is earning revenues, all those people who have provided capital to the firm have lined up waiting to be paid. Okay, so there's a hierarchy for claiming these revenues, and this is the hierarchy. Senior debt holders get paid first. Okay, then you have subordinated debt holders. Okay, and so there is this point of, so remember one thing, another thing that we learned in lab, which you should recap, because now you're dealing with things like IFM, FDRM, raising of capital should be very important, especially for those who are going into banking or analyzing companies. Okay, there is the seniority of the debt and the whether or not the debt is secured are two different aspects of the debt. So the point I'm trying to emphasize here is that the seniority of the debt and the collateralization of the debt are two different aspects. Are you following? Yes. So whether or not, if a debt is secured, we say it's collateralized. Okay, so whether or not it's secured is dealing with the question of collateralization of the debt. Is the debt collateralized or not? So the collateralization of the debt is a separate matter from the seniority of the debt. Okay, the perfect example is the global financial crisis, where, as you know, a lot of residential mortgage-backed securities defaulted. Okay, because the housing bubble popped and the house prices started crashing. and people were defaulting on their loans, so the residential mortgage-backed security started defaulting. Now in those RMBS, all of those RMBSs were secured, but there was a hierarchy of claiming. Are you following? Okay, that's why the higher tranches were rated AAA, those which had more seniority. Everything, just imagine this is a residential mortgage-backed security, which means it's a debt security and it is secured by residential mortgages. Okay, so if Sushant doesn't pay his mortgage payments, then Mittal also doesn't pay, then eventually those defaults will start hitting the repayments on the bonds. Okay, so therefore those residential mortgage-backed securities will start defaulting. Okay, so who gets everything is secured by mortgages, but there is a seniority. So the senior tranches get the most protection. They get hit last by the defaults, and the junior tranches get hit first. Okay, so understand that seniority of debt is a separate aspect of the debt from the collateralization of the debt. Is this point clear? Has everybody understood the statement?
Yes, sir.
Okay, all right. So senior debt, subordinated debt. Now here you have technically hybrid securities, either preferred stock, okay, or what is called deeply subordinated debt, okay, other forms of deeply subordinated debt. And one example I've given you here, which I'll paste into your notes, is COCO bonds. COCO stands for contingent convertible. Okay, you can read up on COCO bonds here. Okay, this is a new development in the Eurozone. Okay, some banks like Deutsche Bank has issued some COCO bonds. Okay, essentially what happens in these bonds is that if there is any kind of financial distress based on certain trigger events, the principal can vaporize. So your entire principal just vaporizes, so then it starts behaving like equity. Because equity can vaporize, you can't complain. If equity vaporizes, you have no right to complain, because you knew that it could vaporize when you bought it. Okay, so it therefore it gets issued as a bond with coupon payments, but if there is a certain trigger event which happens which relates to financial distress, then the equity, the entire principal can vaporize. Okay, so therefore or parts of it can vaporize, so it starts behaving like equity. So that's a hybrid security. So it's a new learning that you can have here, which is COCO bonds and preferred stock. And then obviously after that, this preferred stock should not be here. All right, and then you have common stock, which is of course the riskiest form of capital. Okay, all right, so we learned something new about the hybrid securities, and also about we rehashed this idea of seniority of debt versus collateralization of debt. So all of this is related to our discussion of expanding on this definition of financial disintermediation. Okay, all right, and then we also had this discussion on the classification. Okay, why it's not correct to say that the classification is money markets and capital markets, because you can sell capital securities on in the money markets. Okay, so let's go back to this coverage here. What is the next item we are going to cover? No, not TWS. That Ayush hasn't logged in yet. It's taking a long time to log in. I don't know why it's taking so long. Now it's coming. It's just requesting startup parameters. Took a very long time. Okay, maybe because I don't know what the signal gets affected here in the classroom or not. Whatever. Okay, so in this we have covered asset managers. I went back and covered financial disintermediation a little bit. Okay, now we will look at the next category, market makers. We have already looked at. Remember? We already looked at market makers when I was discussing investment banks, because I said that to be a fairly large investment, in order to become successful as an investment bank, typically you will have to add the secondary capital markets capability. Okay, the purest form of investment banking, the purest investment banking function is just the primary capital markets part. Okay, you can have investment banks, small boutique investment banks, who do only the primary capital markets part. They don't even have the secondary capital markets capability. But typically, in many cases, what will happen is investors will say that I'm fine with buying these shares of Alibaba, but if I want to trade in them later on, will you provide market making facility? I mean, will you provide a market making function for these shares? Okay, and a market making function in securities will become essentially a secondary capital markets operation. Is this clear? So once again, using this language which we used yesterday, a secondary capital markets operation is a species of market making operation. Is this clear? Because market making can happen in Other asset classes as well. I've got too many tabs open everywhere. Let's try still. So a secondary SCM, let's just call it SCM. SCM unit is a species of market making operation. Does everyone understand this term?
Yes, sir.
Okay, Sonam and Himani will also lose points. They are engaged in their own conversation. Sonam is conducting her own class and Himani is a student. Where is this? Now, which group is this?
-4.
So even before Sena has also opened his account. Okay, good. Now, where were we? Okay, we were actually here. Right. So we were saying that SCM unit is a species of money market making operation. Does the sentence make sense to everybody?
Yes, sir.
Clear? Kalra? You're clear about the sentence? No. Then why are you sitting quiet? So tell me now, if it's SCM is a species of market making operation, which of these asset classes that you see, we have listed 5 major asset classes here. An SCM unit is likely to operate in which asset classes out of this list, from this list? Is my question clear?
Yes, sir.
An SCM unit is going to operate in which two asset classes out of this? Equities and debt. The debt, that's not, I'm asking Kalra. Somebody else is answering. Okay, so this is clear to everybody? That is why, and now you understand that, I mean, I'm repeating this species and genus kind of structure, but I think it's important for structuring out your way of thinking, okay? The reason I say that an SCM unit is a species of market making operation is because you can have market making operations in currencies and commodities as well,
Yes.
but they would not be SCM units. An SCM unit has to operate only in debt and equity. Is this clear? Okay, so therefore another statement you can make whenever you have these species, genus structures is, what else can we say? All dash are dash, all dash are dash, but all dash are not dash. That structure, remember? So if I, 1 minute, we are going to test it. Keshav is going to help us. Now we just made this statement, one sec. We just made this statement that SCM units are a species of market making operation. Is this clear? Okay, now on the back of that statement, assuming that statement to be true, you make a statement with this kind of structure. All dash are dash, but all dash are not dash. 1 minute. Not you, Sina. Let Keshav answer. Is my question clear?
Yes.
Everyone has understood my question? Yeah, fill in the blanks question. Yes, Keshav? Give him the mic. You want to answer? You don't want to answer? Okay, Sina, let's give it to Sina. 1 minute. Where's the mic? Where is the mic?
What does it mean by
Give it to Sina quickly.
local code is very loud?
Yes. An SCM unit is the species of market making operation. Now quickly make a statement of the structure that I just gave you. What happened? Anybody else wants to try? Who? Him? Mansi will try? Okay. 1 minute. No. Let's go. Since Mansi has the mic, let her try.
All secondary capital markets are
Secondary capital market units.
units are market making.
Be quiet here, guys.
Are market making operations, but all market making operations are not SCM units.
Very good. Excellent. Has everyone got that?
Yes.
Okay. So that's what we are just, I'm rehashing this maybe a bit too many times.
Sir, CP.
What? CP points here. No, but this is actually, you have understood and accepted that This is not point-based CP. This is CP for the sake of CP. So in fact, I've always, whenever I try to agitate with DG sir that we should remove the CP requirement, because it means that I can cover less material. Okay. So therefore, or what I always tell him is that even when we don't have CP marks, people still participate. Because the point of giving marks for CP was to encourage people to participate. So, but I feel that in many, what I see, people still participate anyway. Whether you have, sorry?
You can reduce the weight.
No, I'm not allowed to. No? He said minimum 20%. He has made a rule that CP has to be minimum 20%. So I'm not allowed to. Okay, let's have this display going. Okay, all right, guys. Now what we want to do, now this is Ayush's account. Okay, what we are going to do is, can I assume, Nagpal, may I assume that in your team, Ayush's account has already been corrupted by practice trading?
Yes.
We can assume that. You have maintained one account as pure, which is to be used for project trading. Is that clear? Is that okay? Okay. This is, we are talking non-NSE. Okay, to be on the safe side, let me see if there's anything in the trade log. There's nothing. Okay, to be on the safe side, I'm not going to corrupt this. Okay. Now guys, please be clear. What you have to do is, you have to make sure that, I'm going to give you Facebook anyway as a setup Facebook. So I'm just interrupting the flow of the theoretical material to just make sure that I okay, so Facebook is not going to be trading now because it'll open at 8 p.m. So we don't have that. But what we want to test is, let's test this, okay? So you have these are the closing prices. The bid offer spread is quite wide. Okay, now let's do one thing here. Let's look at, let's test something here. What I want to test is, it should be, now this is the problem. See, this is what I don't want to see. That if we are getting delayed data on crude oil, that means we have a problem in this account. These accounts need to be refreshed. And if Ayush is facing the problem, that means pretty much everybody is going to face this problem.
But we can use Google Finance.
Google Finance is, I need you to trade in TWS so that I can have the account data, the NLV data. So I need to audit. Sorry? You need to use TWS to trade. You cannot just trade using.
We need a real-time data.
And this is, we are going to be trading 1 minute. You're going to be trading options. Okay, so let me just show you what else has to be set up. Once, so this is all delayed data. This is the problem. All delayed data. So, okay. Guys, now what you're going to do is, it's delayed data, but let me show you what you're going to do, okay? You right click on it, 1 minute. Once we fix it, I'm going to talk to her and get her to refresh the accounts, okay? Now, 1 minute. Once we fix it, you will set up. So let me go back here, okay? So I'm going to give you a bunch of tickers, okay? A bunch of stocks that you'll have to trade. So let's say Amazon is one of those. Let me just press insert here, okay? So say Amazon is one of the tickers. So you'll have to go and enter Amazon here, okay? And you can just enter. So you saw what I did? It'll give you various options. You got to choose stock smart. Smart is the smart routing of, that's a IB, their IP, particular IP that they have, in that they route it to optimally to any of the different to any of the different venues that are available. Okay, so here you see Amazon here. What you have to do is you have to right click, go to trading tools is one way you can do it. Then open option trader. So what you're going to do is, I'm going to show you for one particular stock, but you'll have to do this for all the stocks that are given to you as a universe. Okay? Okay, that's fine. This we don't need again. All right. Now this actually, what has happened is, I have made the fonts. The fonts are very big. Okay. All right. Okay. So what you'll see is, let me try and reduce the buttons. Okay, so what you're going to see here is, the objective of trading here is, we'll show you. Let me close this daily lineup sheet. Okay. So you have various options here, but I'm just going to show you the basic option. It keeps disappearing. Okay. All right, never mind. Nothing is visible because I've made the font size so big. So anyway, you have to get used to this is basically the bid and offer for calls and puts. Okay, and you have tab view is better actually. Okay, it's so big that we can't see everything. Options. Okay, so you have to basically let's do one thing. Let's just go and test one thing. When I give you the go ahead to test, you just test for if you get it on this, you'll get it on the options. You will go and see there's a bid offer here. You can't see the thing because it's too big. The font is too big. So you'll see a bid ask. Okay. You just try to buy any option and see whether you get any kind of information on delayed data, etc. Okay, here you will get some kind of message on delayed data. I think the computer is slow. Or you test it even on the stocks. Test it even on the stocks. Okay, just try to buy or sell any of the stocks in US time. Okay, so make sure the US market is US time should be more than 9:30, between 9:30 and 4. Okay, US time, that is, and US time is, there are 4 different versions of US time, so you have to choose what is called Eastern time. Take the time in New York, take the time in New York or Philadelphia or any of those East Coast cities.
New York and Washington.
Yeah, New York, Washington, Boston, any of those East Coast cities.
That is the Standard Eastern Time.
Eastern Standard Time, EST. Okay, just take the time in New York. Okay,
What are the market timings?
sorry,
Market timings.
9:30 to 4. Okay, so New York time. See, this is now, it's very slow. So if just see if this, that's okay. Just, it's very slow actually. It's not loading properly. So just try to transmit this order and see if you get this message saying that you are trading. This is a normal message that you'll get if there is a problem, is you are trying to trade in a market where you have only delayed data. Okay, this is very risky, etc. So this message you should not get. So when I give you the go ahead to test, go and test it by setting up the tickers. Okay, and ticker setting up, you already know how to do it. You've done it in NSE. You know how to set up the tickers. Okay, so are you guys finding these projects useful or not?
Yes.
Very useful.
Are they useful? Okay. Now, Aryan is not convinced. Pallavi's also expression is not very affirmative. So anyway, but we have to do it because this is just my view of how it should be taught. Because you need to be given the exposure to the first-hand exposure to how markets actually move, and hopefully this will help you to see. You guys remember you've done stuff like this, Harry Markowitz, efficient frontier, and all this stuff. Bell is looking at me like I'm some zombie or something. You haven't done risk return portfolio of Markowitz, so you've forgotten Harry Markowitz's name. Okay, 1 minute. Harry Markowitz portfolio construction. Okay, fine. That's risk return as mean return and standard deviation as the risk of return. Optimal portfolio, efficient frontier. All that stuff you've done. Okay, but hopefully one of the things that you learn is Harry Markowitz is a pure academic. Okay, so hopefully one of the things you'll recognize. 1 minute, please be quiet. Hopefully one of the things you'll recognize, because you have to go out and actually practice in the world of finance, one of the things you'll realize, hopefully, is that after doing all these projects and seeing firsthand how market prices move, what is the level of uncertainty and the unpredictability of markets, okay, even when you're looking at the performance of experts, one of the things you'll realize is how impractical these kinds of frameworks are. That this notion that you're going to sit together at the beginning of a period and classify this, you're going to say that, okay, Facebook is going to have, a mean return of 15% and standard deviation of 6%. If you think about it, these are actually, in real life, you don't operate like this, because are you able to follow what I'm saying? One of the things the response is not sufficiently convincing. maybe you guys are just tired or whatever. But the point is that the point of doing all this and understanding, looking at how market prices actually move, is to understand how impractical many of the theoretical frameworks that are taught in classical finance courses are. Because if you look at this Markowitz portfolio construction business, okay, mean standard deviation, it means you have to look at a potential portfolio of, let's say, 45, 50 stocks. You have to project the mean return and the standard deviation of the return, typically for a longer period like 1 year or something like that. Can you imagine how ridiculous that exercise is? Because it has no meaning. You make a prediction today, tomorrow something happens and everything changes. So in fact, how you have to approach things is that you have to take it on a day-to-day basis. You take a short-term estimate today, you take a view on something, but then very soon you find that it's not working out and you have to take additional steps to mitigate the risk. Either you cut it or you whatever you want to do, okay? So are you following what I'm trying to say?
Yes.
So hopefully when you're looking at all these market movements, you'll get to see how impractical many of these theoretical constructs are. In real life, you can't operate like that because everything is, I mean, many of these theoretical constructs don't show any appreciation for the level of unpredictability that exists in the financial markets. That is something that one of the reasons for making you do these things to give you a first-hand sense of how unpredictable things really are, and how you therefore have to tailor your approach to that kind. And you can't do anything about that unpredictability. No matter how much predictive modeling you do, there's nothing you can really do about the fact that it remains fundamentally unpredictable. Just like life itself is unpredictable. Okay, anybody, even a multi-billionaire, can die tomorrow in a jet accident, right? So nobody's life is guaranteed. Nothing is guaranteed. Okay, so life itself is unpredictable, and so are the markets. So this is an important lesson that you should learn from doing all these things. So don't get fooled by theories and structures and models which tell you that, okay, we are predicting this. This is not physics. Okay, in physics we can predict the path of the Mars rover all the way to Mars. Okay, we can make it land there and stuff like that, because those are stable systems. Markets, economies, and life itself is not stable. So you have to understand these things. This is one of the things that you should understand from doing these projects and seeing how market prices actually move. Am I making sense?
Yes, sir.
Okay. Some people have. Sinha is making up for the lack of enthusiasm of the rest of the class. So, all right. I don't know what is happening here. Maybe my PC is freezing up.
Sir, because it's time.
I know. Now everything is. I can't even see anything.
Sir, I can go.
Okay, I'll let you guys go then.
Thank you, sir.
So some people who are already sleeping, like Double A, Deena is sleeping, Double A, Chabra is also sleeping, leaning back. Who is next to Deena? She is also sleeping. Parmeet is also sleeping.